going to explain why IULs don't work. If you look at the guaranteed column of the illustration, your policy will lapse. And this is an illustration, not a contract. This is not likely to occur. And actual results may be more or less favorable than those shown. So literally in the language, they're telling you this is not likely to occur. That's like the fundamental reason why we use specially designed whole life insurance. My money's growing tax-free. I don't have to report anything. The government doesn't know how much money I have in this thing because it's private. We get to earn interest and dividends on money that's really being used the second time. Welcome back, everybody, to another episode of the Wealth Webinar, where we teach you how to control your money and we teach you how to be the bank. Now, today, I was kind of trying to figure out, what do I teach today? And every week I've got this thing where I got to think about, what are we going to teach? Well, I've been speaking a lot. I've been on the road non-freaking stop, as most of my team has. And this weekend I had the unfortunate but fortunate opportunity to speak at an event where the host of the event brought another company in, a company that I know, a company I talk to, and they are IUL to the core. So I'm up there doing the infinite banking concepts, talking about the infinite banking concepts. I'm on panels with my buddy Richard, who's an IUL guy, and literally the whole room is like, which is better, IUL or whole life? And then the panel, people are like, what's the difference between IUL and whole life? And the unique thing is, I was going and Richard was going. I wasn't being nice, but Stephen, I don't play nice. Like, listen, I say what's on my mind. I even told Richard, I'm like, Richard, listen, if we have to, we can step out in the hall and settle this the old-fashioned way, and I'm totally joking with him because me and Richard know each other, but like, it got heated. Like, we're both going back and forth, but then we found a common ground and we kind of pushed through it. And it had the whole audience was like on the edge of their seats, like, oh my God, are they going to go out in the hall and fight? Like, holy crap, who's gonna say the next thing? It was really cool. So what I thought I would do is not just tell opinions like we had to there because we didn't have actual numbers, but what I did, I went through my archives today. So I tend to be kind of, you can call it whatever you will, a due diligence guy. So I had a buddy, and Stephen, this is your friend. You remember your IUL friend? What's his name? The guy with the big beard, kind of looks like he's a country guy. But anyway,
I thought it was maybe Devon's. I think that was Devon's guy down in Phoenix.
Oh, it was Devon's guy. Darn it, I'm confusing it. So it was Devon's guy, not Florida man guy. I can't keep him straight, Stephen. I just can't. But I asked him this. I said, listen, we're friends because we are friends with that guy. And I think his name was Sean or something. His name should be on here. Aaron's his name. And Aaron does IULs, okay, but he also does whole life and IBC. And he uses them for completely different use cases, completely different solves. And I said to him, listen, everybody keeps saying IULs are better for the infinite banking concepts. And then I said to him, however, the Nelson Nash Institute, the only practitioner organization in the infinite banking space, says and firmly warns IBC practitioners from using IULs for the infinite banking concept. An IBC practitioner, which I am, and most of our team is, and all of them will be, we are forbidden to use IULs and the word infinite banking in the same sentence or in the same use case, and for very good reason. Literally, they economically broke down the reasons, and I'm not going to go that boring with you because every one of you will fall asleep, but I went to Aaron and I said, hey, dude, I want you to create an IUL, and I want this thing to be called the Whole Life Killer. That's what I said to him. I said, create the Whole Life Killer. Pull out all the stops, reduce your commission. I said this to him, and he knew I was joking because he knew he couldn't kill a whole life with an IUL for infinite banking. But he said, here's what I'm going to do, Chris. I'm going to do an example for you, and I'm going to do it where I strip my commission out as much as possible. I'm going to custom design this policy, this IUL, where I'm going to take my commission out to the minimum. I'm also going to click, there's a rider in IULs where you can spread your commission out over a couple years, which adds more cash to the whole life. And then I'm going to basically show you those numbers, and we're going to break down the returns. Fair enough. You're all going to have to help me because I don't have these numbers all figured out. So I'm going to need some help with calculators. And then what we're going to do is we're going to take, I'm not even going to use a good design. I'm sorry, let me rephrase that. I'm not going to use the best design because I feel like that wouldn't be fair, right? I'm just going to create a normal 75-25 whole life policy designed and engineered by our team. So it's not the highest high cash value policy, but it's good. And we're going to compare the two, fair enough? And we're going to look at them and you're going to see why IULs have a lot of problems. And I'm going to start with the numbers. And then what I'm going to do, then I'm going to explain why IULs don't work. I'm going to explain why this IUL, the whole life killer done by our friend Aaron, wasn't able to beat just a normal whole life policy. And then I'm going to talk about some other differences. But then we're going to finish up, not just with Florida Man, but we're going to finish up with something that I've never ever shown before because I've never been able to. I'm going to show you the difference that there's two types of designs that we can use. Okay, we can use a direct recognition company or a non-direct recognition. So let me explain this to you, and I'm just going to draw it real quick. So there's direct recognition, and I'm not going to tell you which company's live, and then there's non-direct recognition companies. Okay, there's a big difference for what we do between these two. Can anyone in the chat tell me the difference between direct recognition and non-direct recognition? And while we're doing that, and someone's going to put that in the chat, I just want to know, how many of you are brand new here for the very first time? Like, how many of you have never been on a wealth webinar? Put I in the chat. Chris Naugle, I'll get to that question about the money, guys. How it's treated when it comes to the loan. Yep, loans are not deducted. Okay, perfect. Who said that? Tess said that, I think. A couple of people. Yeah, Tess nailed that. All right, so we got a bunch of Jerome, Arthur, Leonardo's been here 3 times. I love your name, man. All right, perfect. So we got a couple of folks who are here for the first time. Now, let me just warn, I'll just mostly speak to Arthur and Jerome. This is good. I'm going to go fast, but then I promise I'm going to bring it back. So if anything I'm saying to both of you, if you're brand new to the infinite banking concept, brand new to this stuff, just so you know, the beginning, I'm going to be a little bit high level. Okay, but then I promise I'll bring it back and I'll explain everything. Fair enough? I just don't want any of the first timers, Dawn, Kendall. I just don't want you to think that I'm like going like in no man's land or where you just don't understand what I'm saying. But it's vital that I get this part out. So here's the difference, all right? When we take a loan from the policy, okay, and we're specifically talking about a whole life insurance policy here. So let's table IULs for just a second, and let's talk about whole life policies. So in the whole life policies, what we do is we take loans from the policies and we use that money to make us more money. We use it for private banking, right? That's all we do. We use it to do banking in our life. But when we take a loan, what the insurance company is doing is they're going into their general account of the giant mutually owned insurance company, and they're taking the money from the general account. Then what they're doing is a calculation, and they're subtracting the loan from the death benefit in the policy. So we are reducing our death benefit. So really the simplest way to say how these life insurance companies give us loans is they take the loan from our future death benefit that they promise to pay out when we die. Fair enough? So because of that, when they take the money from our death benefit, our cash value can still earn interest and dividends like the money never came out. But you see, I'm not giving you the whole story if that's all I tell you, because that sounds pretty good, right? I put 100 grand in a policy. And let's say I take 90 grand out. With what I just explained, the 90 grand I took out as a loan, that wasn't my money. That was the insurance company going into the general account, then subtracting that loan amount from my death benefit. So essentially, the insurance company is giving me part of my death benefit while I'm living. And then they collateralize the loan with the amount of money I have in the cash value. So if I had 100K in cash value and the insurance company gave me $90,000 as a loan, I still have $100,000 in cash value, but that $90,000 that they gave me came away from my death benefit. That's the advantage. We get to earn interest and dividends on money that's really being used the second time. That's freaking awesome. That's like the fundamental reason why we use specially designed whole life insurance from a mutually owned company that pays dividends. And that has some little hooks too. Now we need to understand two things: direct recognition versus non-direct. Now, almost every policy we do is going to be a non-direct recognition policy, with the exception, and I'll just give it out there, in New York, we use a company called Guardian. Guardian is direct recognition. Guardian's a great company. R. Nelson Nash was a Guardian agent. So, like Guardian works for the infinite banking concept because the pioneer of the concept worked for Guardian. So, but being a direct recognition company, that would mean if we started, now let's just do this. Let's say we've got cash value of 100,000 in a direct recognition and cash value of 100,000 in a non-direct recognition company. If we were to take a loan for $90,000, okay, this is our loan, that 90,000 doesn't subtract from our 100, so we still have $100,000 in cash value, but this 90,000, the 100,000 collateralizes, so it serves as collateral to protect that 90,000. But in a direct recognition company, actually, what happens is they do everything I just said, except for now, they do recognize the loan. So your cash value is still 100 grand, okay? I want to be clear about that. Your cash value is still 100 grand. But what they do is they factor your future dividend on the 10,000 because they recognized that you took a loan. Now, I'm leaving some stuff out, but does everybody understand the fundamentals of what I just said? Now, if we were doing that, but now our dividend that the insurance company pays us is only based on the remaining amount, not the full amount, you can see where that could be problematic. But over here, if we did that same thing and we took a loan from a non-direct recognition company, which is pretty much every company, we are still getting interest and dividends. You still get interest on the 100, but over here in non-direct, they don't recognize the loan. So the insurance company says, oh, well, we didn't even recognize the loan, so I'm still getting dividends and interest on the full 10,000. So when you hear that, you're like, oh, hell no, I don't want a direct recognition company. But you might. And what I'm going to show you is I'm going to show you for the first time I've ever done it. I'm going to show you an example of a real client of mine who has a direct recognition company. I'm going to show you his policy from when we first started it, which just so you all know, dividends have gone up twice with this company since we first started it. That was 5 years ago. He has taken loans from the policy every single time he had cash value. He's very good at using the infinite banking concept. And I'm going to show you where we're at in the 5th year with loans taken out. And you will easily be able to see the impact of a direct recognition kind of company. Fair enough? All right. But with that being said, I want to get back to the IUL. So let's go into the IULs. So here's the difference. So all the rage, all the buzz out there in the street is IULs, indexed universal life, okay? This is what every broker wants to sell you. This is what most agents want to sell you, and especially if you meet somebody who's new in the industry, they are definitely selling you an IUL. Why? Well, they pay a high commission, okay? And there's a lot of other reasons, but let me just fundamentally show you a couple things. IULs are a relatively newer product. They've been around about 20 years. Hey, Stephen, how long have whole life policies been around? Give or take a year or two?
200 and some?
Yeah, about 200 years, let's just call it that. Do you want a product that has been time tested for 200 years, or do you want a product that's been time tested for 20 years? Right, I don't even need to ask the question. So anyway, who cares about that though? They're all the rage, and they're all the rage because they spawn from a couple other products. You see, first of all, back in the 80s, insurance companies, there was only a couple products back in prior to the 80s. There was, there was endowment policies, which are basically whole life policies, and then there was term insurance. In the 80s, Ralph Nader, if I'm not mistaken, I think that's who it was, decided that whole life policies were not transparent and they needed to be more transparent. Hence, the insurance companies built a new product called the universal life. And holy crap, like it took the industry by storm. Number one, it had lower cost of insurance. So I'm just going to show it like this. Okay, your cost of insurance, which is the cost for the death benefit, if you don't know what that means, every single year got more expensive. So this is what your cost of insurance looked like. But in your younger years, it was like term insurance. Oh, I'm sorry. It actually is just like term insurance. Every single year, term insurance gets more expensive. So a universal life, they said, all right, well, we're going to use a term insurance model, and we're going to have it so that when you're young, it's super cheap, and when you're older, it's super expensive. And that makes perfect sense for the insurance company, because when are you more likely to die? When you're younger or when you're older? Older, right? And when does the insurance company want you to lapse your policy? When you're younger or when you're older? when you're older and closer to getting paid, paying out the death benefit, kick in the bucket. So if we make the policy more expensive over time, there's a higher probability that the cost in the policy is going to make it probably feasible that you might not be able to pay it. Then what they did is they said, all right, but we're going to basically make the premium level. So we're going to make your premium in the policy 100% level, just like a whole life. So if you start a policy at $200 a month, or in universal life, you're always buying a death benefit. So let's just say you buy a $100,000 death benefit and it costs $200 a month, which would be the right way they do it. Now your premium is level. But you see, then the salespeople got a hold of it because there was another cool thing, and I'm going to build into IULs, but the IUL is the same chassis as a universal life. Understand that? It's the exact same thing as a universal life, just with an added little amenity, if we will. So then they came out and the salespeople said, well, okay, yeah, but what if I can't make the $200 payment? And the insurance company was like, well, since we also have cash value in the policy, okay, and the cash value is based on an interest rate. There's two interest rates. There's current. So let's just say the current interest rate's 4%. And then there's the minimum guaranteed. Okay. And the minimum guaranteed, let's say, is 2. But right now, let's say we're getting 4%. So they look at the illustration. They say, okay, if we're making 4%, but we built the policy to survive at a minimum of 2, well, if your cash value is growing like this at 4, well, then it would grow like this at 2%, but it'd still stay alive. This is your 4% cash value. This is your 2. The insurance company said, well, then there's flexibility in the premium. Yes, you can reduce your premium to anything you want within reason. So client gets into the policy. He's like, well, I don't like making premium payments, so I'd like to reduce my premium. Oh, sure. How much would you like to bring it down to? Well, I'd like to bring it down to $100 a month. No problem. They bring it down to $100 a month. So now $100 a month is sufficient at 4%, but now the Fed drops interest rates. And the policy is now performing at 2%, not 4%, which would have been okay at $200 a month. But now, because you had flexibility and you reduced it down to $100 a month, now it ain't okay. So now what's going to happen is eventually at a certain point, I'm going to need a different color, at a certain point in time, you're going to hit this threshold, let's call it right here, where now your cash value is starting to be diminished because the cost of insurance. So your cash value is going to start doing this. Because the internal cost of the policy is going up, your interest rate went down, your premium went down, and now all of a sudden your cash value is just getting eaten alive because it's paying for a higher cost of insurance. Does everybody know where this ends? It's quite simple. It ends in a couple words that is music to the insurance company's ears: lapse. And just so you know, when a policy lapses, no one gets the death benefit. You have nothing. All the money you spent on the policy is gone. Oh, I'm sorry. It's just like a term insurance policy. Nobody dies, nobody gets paid, you paid all these premiums, it all went to the insurance company and the insurance company wins. So in other words, universal life was a great product because universal life put the risk on the insured. So it reduced the risk for the insurance company. They loved it. They loved it so much that when I started in the industry in the early 2000s, they took this same exact concept. They took this exact same concept, but they said, screw this current interest rate shit. Let's invest. Like the markets are so good. This was right after the dot-com crash. The markets are so good. Let's keep the floor. Let's keep all the things the same. But now let's let the clients invest the money in mutual funds in what's called a separate account. Because, hey, everybody wants this buy term invest the difference shit. By the way, if any of you think buy term invest the difference is the way to go, you must read our white paper because we debunked buy term invest the difference by the math. This is available for free to anyone that wants it. Just send us an email and I'll give you that email in a little while. So then they said, all right, we're going to use this VUL chassis, but we're just going to put the letter V or the word variable in front of it. Meaning now the separate account full of investments, you can do the same thing. All the rules are exactly the same. Okay. You can put money into the policy. It's flexible. But now you can invest in mutual funds. So you're not capped by this 4% interest rate. Now you could make 12, 50, 100% on your money. But they forgot that you can also lose money in the market. So what happened in 2008, I owned one of these vehicles and I'll tell you exactly what happened. Everything was going great. the policy was beating my illustrations, which I put a hypothetical. Oh, they were the easiest thing in the world to sell, because we could just go in and do an illustration and I could tell a client, all right, well, based on this mutual fund portfolio, the average rate of return on this was 9%. And I can illustrate this thing at 9%. Man, those things ran to the moon and back and to the moon again. And then you could get super creative. You could be like, well, at 9%, shoot, if you started at $200 a month, look at how much cash value you have. And we'd show these cash values like this. And then all of a sudden, you know, what we'd say is even if the premium was reduced down to, this was called target. There was always like a minimum target. If the premium was reduced down to target, no big deal. You're only going to have just a little less cash value because you're making 9%. But then all of a sudden the markets didn't do 9%. And, you know, one year you lost money, and that was 2008. And then 2009 again, and you lost a bunch of money. And then all of a sudden, what happened? The cash value went like this because it followed the market, because your money was in mutual funds. So when it did this, I'll tell you one thing that happened. Letters were sent out that policies were going to lapse if the client didn't increase their premium. How many of you during a recession would love to get a letter that says, hey, I'm so glad you bought this variable universal life policy that, you know, it's doing great. You've had a great run with this, but now we got a little problem. Those mutual funds in the separate account have lost a little bit of money, just a wee little bit. And now you don't have enough cash value to support the cost of insurance because you've had this thing for 10 years. Your cash value is not supporting your cost of insurance. And the amount of premium you're putting in isn't enough. You're going to have to double the amount of premium you're putting in just to maintain the policy, not to grow it, just to maintain it. How many of you would be like, oh, shoot, man, that's no problem? Not at all. I just lost my job. We're going to lose the house. It's getting foreclosed on. Yeah, I'm having a hard time putting groceries on the table. Yeah, I totally understand. You know, the market went down, so my life insurance policy that I bought so that my family would be protected when I die, now I got to double the premium going in. Yeah, no problem. How about I just sell the car to pay the premiums? No, people lapsed these policies. People got rid of these policies. They were like, I don't want anything to do with this anymore. So in their ultimate wisdom, final thing, hopefully this isn't too boring for you. In their ultimate wisdom, what they did is they created this new Frankenstein called an indexed universal life. All the same rules. So now I'm going to go really fast because everything's exactly the same. Except for now what they did is they said, instead of putting money in a separate account that you, the client, holds all the risk if the market goes down, how about we manage those investments? We, the insurance company, will manage an index. And that index, we will buy derivatives or call positions on it, and we'll stabilize this. And you, the client, can just participate in our returns on these indexes. But you see, if you do it that way and we just let you participate in our returns, in other words, give the insurance company more control, you just participate in our returns, you can't lose money. Because what we're going to do is we're going to put a floor under your return. So remember before the universal life had that guarantee? Well, an IUL also has a guaranteed floor. And each company is a little different. I think this one that I'm going to talk to you about, I don't know what the floor is, but let's call it 1%. So, and how they sell these products, the IULs, they'll tell everybody, hey, you can't lose money. You can't lose money. If the stock market goes down and goes negative and we're in a recession, you are guaranteed to get the floor, 1%. Is that true? Well, yeah, kind of is true. Until we factor in the cost of insurance, until we factor in the policy's fees, until we factor in commissions, now it's not true anymore, because now you 100% can and will lose money, because at a 1% floor, that's not enough to stabilize the cash value and the cost of insurance, and the premium, the same thing, can go up. They hold all the cards. IULs give all the control to the insurance company. I mean, all of it. And not only that, take all the risk and put it on you, the client. It's the greatest fucking thing ever. Sorry, put money in the swear jar. Everybody knows I'm from New York, right? I have a license. They issue New Yorkers licenses to swear, just in case anybody was like, oh my God, did you just say the F word? We have a license. It's okay.
Can't get a gun, but you can cuss all you want. You're good.
Yeah, and you're part of the country that might not be cool, but up here, like, that's how we talk. So I just didn't want anybody to get mad at me because I was cussing up here. But, you know, like, this was the greatest thing ever. And they are selling these things because now how they can sell these is, remember I said back to the IUL, the agent can go out and be like, hey, I'm going to illustrate this thing at whatever rate of return. Well, there are rules. I think they can go like, I don't know what it is, but let's call it 7%. I think it's a little less. Let's be fair and say the agents selling this can illustrate it at right around 6%. And also here, I forgot to, I'd be remiss not to tell you this. They used to be able to illustrate these up to like 7, 8%. And then the regulators looked at these and said, whoa, these are not working. These are failing. They put regulations out to sell the agents and the companies. Hey, you can no longer illustrate at 8%. Now it's 7. Oh, and then they came out again and said, oh, no, you can no longer illustrate at that. Now you can only illustrate at this. Why? Wait, hold on a second. Let me ask everybody a question. How long has the last bull run been? Like, how long has it been that we have had an upward moving market outside of the pandemic? I get it. But outside of the pandemic, how many years has it been? A lot, right? Enough? Has it been long enough? It's been a long time since we've been in a recession. So therefore, this is one of the longest bull runs in history.
Also, when they're buying these call options, as they buy more, don't they become more and more expensive?
Oh, so James has got a good point. It's these options that they're buying, which nobody wants to know anything about. You just want the pretty illustration to show the pretty return. And just so you know, my pretty illustration here is illustrated at a hypothetical interest rate of 6.25%. Okay, so this is what mine is shown at, 6.25. And then I've got a guaranteed floor, which usually it's not on the same page, which is always interesting because in a whole life, just so you all know, there's a guaranteed column and a non-guaranteed on the same page. And some of these IULs, because they're so complicated. And by the way, folks, IULs are single-handedly the most complicated product ever created by the insurance company. And that might not be a factual statement, but I'm going to tell you they're pretty freaking complicated. The IUL guy even said that he's like, yeah, these are very complicated contracts. I'm like, you don't say. I've tried reading the contract, and I seriously think I need to hire an attorney, and that attorney needs to hire another attorney just to understand this. But anyway, I don't know what the guarantee is on this, probably 1%. So this is the hypothetical rate that they gave me. So everybody understands how an IUL works. It's a rising cost of insurance. Every single year, your cost of insurance goes up. You have flexibility in premiums. Your hypothetical rate, the 6.25, is tied to some index that the insurance company buys and manages, and then the insurance company buys options, call options on that index, and those cost money too. But James made a good point, and this is something that's been happening a lot lately. You've been hearing about it a lot, and the regulators certainly are talking about it. Because so many products and so many people are getting into these IULs and these indexed products is what we'll call them, there's a lot more people buying contracts, a lot more people buying calls on these indexes. So, James, what happens when there's a lot of demand and only so much supply?
Price go up.
Price goes up. So the derivatives, the options, the contracts have gotten more and more expensive. And there's lots of reasons for that, not just supply and demand, but they've gotten more expensive. So now the insurance companies, I'm missing an important thing, folks. These things have what's called a cap. Okay, the cap. Now, your cap on your IUL could be 10%, which means the insurance company will allow you to participate in the index. Some of you are probably just like, holy shit, my head's going to explode. This is so complicated. I said it's the most complicated product there is. But anyway, just stay with me. The cap says that you can participate in the insurance company's returns in the index up to a maximum of 10%. But then they came out with uncapped. Yep, uncapped. Which basically means, well, it doesn't matter where that index goes, we're going to let you run with it until you read the contract and you realize that the insurance company can change that cap rate any time they want. And they have. They have been reducing cap rates because why? Costs have gone up on the options. I hope everybody's super confused, right? Because here, they're not sold like that. When you buy one of these suckers, you're not going to be sold on all that. They're not going to explain all that. They're going to tell you all the good things. Mr. or Mrs. Client, look at this illustration. Oh my gosh, if you put $12,000 into this thing for a period of 10 years, oh man, you're going to have a ton of money. You know, if you do this till retirement, which is 65, you're going to have a whole bunch more money. I mean, this thing's going to be phenomenal for you. They just show you all the good shit. They never tell you that the returns on the indexes definitely aren't static like they're showing. Because remember, in this whole life killer that I had my buddy do, well, it's actually Devin's buddy, so let me be clear about that. He's not my buddy, but I like him, so I can call him my buddy for today. So in this product, he basically built this thing different than your agent probably would build your IUL. but let me just give you the best and then I'll show you a normal one, which is this one right here. Okay, fair enough? All right, so here it is. This is on my life. So I'm 46 years old. The hypothetical interest rate on this product is 6.25%, and I'm going to put $12,000 in each year. So year 1, 2, 3, 4, 5, 6, 7, 8. We'll kind of jump around a little bit. So year 1, I put 12 grand in the policy. How much money do I have? Now there's 2 columns that we have to focus on, okay? There's an accumulation value, and this is what they always sell you on. Oh, wow, look at the accumulation value. But then right next to it, sometimes hard to find, is the surrender value. Let me just ask anyone a question. If you had one of these policies, which one do you think is the one you can take money from? Do you think it's the accumulation value or the surrender value? Put it in the chat. Yeah, definitely the surrender value. That's the one you can take from the cash value, right? But so this one, we put 12,000 in, and in year 1, and we have accumulation value of 9,959. If I made 6.2, remember, this is all assuming I make 6.25. And I have a surrender value of 8107. 8107, okay? Year 1, let's just go year by year here. Now, let's come over to a stupid whole life. We're gonna do the same thing, okay? We're gonna come over here, and I'm just gonna kind of go page by page. Now we're gonna do a specially designed whole life. 2, 3, 4, 5, 6, 7, 8. Same thing, 12,000 per year. And we're going to put 12,000 bucks in. I'm 46. It's specially designed whole life. Nothing even fancy, just a normal design. So year 1, I put in 12,000. Now in a whole life, there's a guaranteed column and a non-guaranteed. And the only difference is the dividend. So the dividend is not guaranteed, but the interest rate is. The dividend is non-guaranteed, okay? Which is what brings us to this middle of the road guarantee. Now, this insurance company has paid dividends consecutively each and every single year, never missing one. And we're at, I think, a 35 or 36 year low on dividends. It's the lowest dividends that have been paid in that period. So let's just run the math. 12,000 bucks goes in year 1. My guaranteed cash value, 8,467. That's if they don't pay the dividend, but they probably will pay it. So my non-guaranteed is 9,306. Okay. How much money can I actually use in this contract? 9,300. Well, I can use 90% of the 9,306. But the IUL is going to be the same. It's 90%. You can't use 100%. Let's come back over here. If I was comparing these and I was shown this one that has 9,959 when the whole life only had 9,306, which one would you think is better? You'd be like, well, I want the IUL. It's better. But is it better? Because I only have access to 8,107. Do you want access to 8,107? Actually, 90% of that. But let's just, you all know you can use 90%, okay? You got 8,107, or I can use 90% of 9,306. Now, for the infinite banking concept, which one's looking better? But let's just keep going. Year 2 in the whole life, I put 12 in. Okay, my guaranteed interest, I'm going to skip guaranteed just because of the way I do this. I got to come over here. So my cash value, where are we? 20,000. All right. So my cash value is $20,320. Okay. Now I'm going to come back to the IUL. The IUL, and this is going to get boring, which is why we're going to jump ahead. I'm just trying to show you. The IUL has an accumulation value of $20,453 and has a surrender value of $18,793. This is the whole life killer, just so you know. So now we compare that. The whole life had guaranteed cash value of $18,278. Yeah, but this isn't guaranteed. And then it had, let's see, $20,302. So $20,302 was the whole life. So I'm better on the accumulation side, but that's only if I made 6.25. How the IUL person would be like, yeah, but what would happen if you made 10%? Well, you'd have more, silly. But you would still not beat it over here because I have 20,302 to use. You have 18,000. Let's just keep going on this. And then all I'm going to do is I'm going to read these to you. So this is the IUL. I'm not going to do the whole life anymore, and I'm just going to give you these. So we got 30,036 is the surrender value, but we got 31,488. And I'm going to come down here to year 8. Okay, I'm just going to jump ahead. Year 8, we got 12. Let's see. We got 95, year 8. So it took 8 years. 95,942. And we've got 95. So we're super close. 95,528. Now, a lot of things had to happen for us to hit these numbers 8 years in. We had to have gotten 6.25% each and every single year. You might have done better in a couple of the years early and lost money in later, or shouldn't say lost, but hit the floor. But nonetheless, let's just come over here and let's just do a different color, and I want to compare some numbers. We'll do red. All right, so year 3 in the whole life. Year 3 in the whole life, we have 31,894. Ooh, what happened? Now the whole life in the third year even beats the accumulation value. Oh, but wait, we have 31,894 over here. Let's go down to year 8. Now, there's one thing that's unfair here. I should not even be showing you this. The IUL accounts for $12,000 going in. In year 8 of this whole life policy, I'm only putting $11,833 in. So I'm hurting myself by about a little less than $200, but who cares, right? Because I dropped the term on this. So this one, I've got 99,707, and I've got 99,707. Folks, don't even make me keep going with this thing because it just gets worse. And I don't want to embarrass the IUL anymore. But like, how can it be? This thing made 6.25% hypothetical every single year. The whole life, that whole life illustration was done at, so the whole life was based on a 5.2% dividend crediting rate, not 6.25, but yet the whole life still beat this. How can that be? One has a rising cost of insurance, the other does not. And we're assuming that everything is perfect in this IUL. We're not even assuming that we lost money a couple of years. But here's the best part. In almost every IUL you will ever look at, if you look at the guaranteed column of the illustration, which I don't know why I don't have it here, your policy will lapse. If you got guaranteed returns, your policy would lapse. And let me prove it right here. And also you should read the disclaimers. I did a YouTube video on this, but this is a company called Minnesota Life, probably shouldn't, but everywhere where there's highlights in this are all the fine print that you need to read and understand. Look at how long this is. Fine print, fine print. Important, it says at the bottom, important. This illustration is not a contract, assumes current illustrated non-guaranteed elements which will remain unchanged for years shown. It is, can I just read this? This is very important. This is from the IUL. Important, right at the bottom of your illustration. This is an illustration, not a contract. This illustration assumes that the currently illustrated non-guaranteed elements will remain unchanged for all years shown. This is not likely to occur, and actual results may be more or less favorable than those shown. So literally in the language, they're telling you this is not likely to occur. And they're right, it can't occur because there's no way you're just going to get the same return every single year participating in the market. You can't. So this one is pretty interesting, and I just want to point this out. Now, this is not designed by my buddy, so this is what you could expect your broke-ass brother-in-law or your lying-ass advisor who's trying to sell you an IUL to show you. So this policy is interesting. They showed this thing, and they said, hey, if you put $100,000 in each year for 5 years and you never put money into this thing again, you're going to have, let's see, at retirement at age 65, you're going to have $1,174,791. How many of you want that? How many of you want to put $500,000 in over 5 years to take out $1.174 million? And if you die, you got a $2.6 million death benefit. I'll take one of those. Yeah, sure. Great. Give me one. But if you read the fine print and you go in and look at it and you look at the guaranteed values, by the time you're age 65, you have $346,000 guaranteed, and you are guaranteed by the age of 73 to be out of money and lapsed. And this is assuming a hypothetical interest rate of 6.48. You see, they do all sorts of crazy stuff with these policies, like tell you, oh, well, we can put money in it for 5 years and you don't ever need to fund it again. And it's just going to be perfect. It's going to keep running. You're never going to run out of money. It's just going to be awesome. I'm going to pause because I'm sweating because I get so freaking upset about these things, but I just brushed the surface. I literally just brushed the surface on this. All I did is just showed you a stupid, specially designed whole life, not even anything special. Like our team could do a better illustration than that. But then I showed you 2 hypothetical IULs, and even the one that was designed by my buddy to be the best IUL you could design, and that is pretty sexy for an IUL compared to the ones I've seen. Most IULs, the money you put in the first year, you're going to have like 50% or less that you can use in the first year because of the surrender value. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. I want to hit one other thing. And I also want to talk a little bit about the infinite banking concept real quick, if I may. So we just went through IULs and whole life. And the reason I did that is because I keep hearing about it over and over and over and over and over again.
Chris, you can hit this too. They just said, would love a follow call waiting on a quote for a whole life single pay premium early access withdrawal with the intention to use for infinite banking real estate. So that's obviously not a great plan. So maybe we can get into that.
No, I do love single premiums, but here's the thing you got to understand. In a single premium, which all that means, folks, is you put money in one time. So let's just say somebody had a windfall of money. Let's say they got $1 million and they just dump that $1 million into the policy in one shot. So now you got a single premium whole life policy and you just put $1 million in it. You never have to put another dollar into the contract a day ever. So if you put $1 million in, you'd probably get like a $6 million death benefit. I'm just guessing. So that's your death benefit, but that's probably pretty close. So that's a single premium. So that sounds fantastic, especially if you're going to use it for real estate. But here is where you got to be really careful. By doing this, you automatically create a modified endowment. You mech the policy. There's no way around this. You will mech the policy. So whoever said that, you just understand your policy is a mech, which means the cash value, which let's just say you put $1 million in, you got 900,000. I don't know that your numbers, but let's just say if we did it, that's about what it would be. You got 900,000 bucks, and then you're going to use it for the infinite banking concept. So let's kind of come over here. I want to start drawing this, and we're going to use this for the infinite banking, which how that would work. We got 900,000 in cash value. What we're going to do is we're going to take a loan from the policy for let's just say 900K. And we're going to go out and we're going to buy this apartment complex. Here's our apartment complex. That little bugger. We'll do an 8-unit. Not bad. Put some little trees in here. You know, got to make this thing look good. Green space. And then you got your little air conditioning unit on the top because it's pretty freaking hot out. All right. There's our apartment building. We're going to buy for 900,000 bucks. Okay. Then what we would do is we would take our net rental income. There's two different ways. You could take the rental income. How I would do it is I would loan the 900,000 to my entity. So let's say it's XYZ Corp bought the property. I loan 900,000 bucks to that, and I do a promissory note and a mortgage. I mean, you don't have to do the mortgage; it's your money, but you do that, and you charge yourself 6%. Okay, and then you could do it either one of two ways. You could take all of the net rental income, or you could just repay the policy the 6% interest on the loan. Okay, which let's just do this. Let's say you did a simple interest loan, which in a case like this, I probably wouldn't do simple interest, but let's just, for the sake of math, 900,000 times 0.06 divided by 12, 4,500 bucks a month. That's what that would work out to be if you did an interest only loan at 6%. Now, would that make sense? Yeah. Depending on the policy that you do, the loan interest rates are about 5.2%, give or take the company. Okay, so if you're getting charged 5.2 for the loan from the insurance company, you still got a $900,000 cash value earning interest and dividends at a rate of, let's call 6%. So if you're making 6 and you're being charged 6.2, are you happy? Yep. But then over here, if you're charging your company 6, what is 6? Are you happy over on this side? How many times are you making money? Twice. You're making money twice on the same dollar. But here is the problem. Because sorry. For whoever's question that was, I went long-winded on that because I wanted to explain the infinite banking concept. Folks, this right here is the infinite banking concept. That circle, that's all it is. Making a spread on your money is the infinite banking concept. And the definition of the infinite banking concept is taking back the banking functions in your life. Did you not take back the banking functions in your life in this transaction? You did. Instead of going to their bank and paying their bank 6%, you went to your bank and borrowed money and paid yourself the same amount you would have paid the bank. Hence, you're leaking no money because every penny of this $4,500 6% interest that your company pays to your policy is in your account the next day. So every time you deposit $4,500 as a loan repayment in your policy, you have $4,500 to use. Not only that, every time you put $4,500 in, you're reducing the loan to the insurance company. So each month you're paying interest at a rate of 5.2 as per one company we work with. You're paying 5.2 on a reduced balance every single month. So you're actually paying less interest because of the way the amortization goes, the way simple interest calculation goes, you're paying down the loan. So you're not actually paying 5.2 on 900, you're paying 5.2 on a declining balance while your balance is going up because it's compounding up. You took back the banking function in your life. In this scenario, here's where you'd have to be careful. You MEC'd the policy. So your policy is now 100% a MEC, which means it is taxed just like any other investment. So when you took that loan out for 900 grand, if that loan had any gains in it, you would get a 1099. The insurance company would send you a 1099 for whatever gains above and beyond your cost basis that you have. So now as this 900,000 compounds and grows, as you keep making more money, you are paying tax on the gains. So it is no longer tax-free. Does that mean it doesn't work for the infinite banking concept? No, not at all. It does. It 100% does. But what I would factor in is whatever the taxes are you're going to pay over here, make sure it's justified over here. So you're probably not charging 6, you're probably going to have to charge 8 to make up for the taxes you're going to have to pay on the gains. Fair enough? So that's the only issue. And that rule happened in 1988. It was the MEC limits came about in 1988 because wealthy individuals were piling money into whole life because they were tax-free growth. The internal buildup of the cash value grew tax-free. So these oil tycoons are taking billions, dumping them into the insurance companies and be like, sweet, I'm getting 6% on my money. My money's growing tax-free. I don't have to report anything. The government doesn't know how much money I have in this thing because it's private. It was awesome. And then in 88, they said, whoa, we got to close that loophole. So they came up with the MEC. I know that was long-winded, but hey, listen, you can never, ever learn too much in this stuff. What else we got, Stephen?
They did just clarify a little bit too. The plan is for 80,000 single pay deposit with 7-pay premium of 8,000 on a 27-year-old daughter, decreasing to 4,800 till retirement.
That was a great lesson in how to MEC a policy, but Wanda, she is not MECing it. So she's dumping 80,000 in. So it's not $1 million, it's 80,000. I mean, I was only off by a little bit. So 80,000 in. Okay?
I didn't interrupt you because it is still a good discussion, what you were sharing.
It was a good discussion. So you put 80,000 in, let's say you can take 75,000 out. I don't know, hypothetically, you still got the 80 in here growing or whatever the cash value is. Maybe it's 75,000 growing. And then it's a 7-pay, which what that means is she dumps in 80 grand. Okay, that's called a dump in. And then she's going to make premium deposits for 7 years. I think, is it 7 years? Yeah, 7-pay premium. So the 7-pay premium is $8,000. So she's going to make premium deposits of $8,000 for 7 years. And after the 7th year, she could reduce that premium deposit. Maybe even stop that depending on the contract design. Let's see, 8,000 on she did it on her daughter, which is phenomenal. Yeah, 4,800. So after the 8th year, it goes to 4,800, which is down to base. So that's actually like it's almost like a 50-50. That would be about a 50-50 blend. Okay, which is fine because you're doing the dump. So when you're doing this dump in, the split between base and PUA for this is pretty close to 50-50, but you've got term insurance, which is making up that other $200. So 50% and 50%. And a lot of people are like, oh, why isn't it 75-25? Why isn't it 90-10? Well, because it can't be, okay? Because it can't. You can't do it. I know on all those fancy videos you watch, those gurus, those IBC gurus come on and say, oh, you got to do 90-10. 90-10 is the only way. Tell those bastards to run this scenario. Tell them, hey, I want to put $80,000 in as a dump in. I want to put $8,000 in each year, and I want it to reduce down to base after the 8th year. Oh, and I want it to be a 90-10. One of two things is going to happen. They're going to say, nope, sorry, we can't do that. Or they're going to give you an illustration, hoping you don't look at the actual design and say, this isn't a 90-10. This is more like a 60-40 or a 50-50, which it will be. But then they forgot to tell you it's not a 90-10. I see that all the time from, I'm not going to name the damn company, but it has IBC in it. And they don't tell you, or they load the sucker up with so much term insurance that it just eats the policy alive in the later years. It's just like, this is a good design. So who is that, Wanda? This would be a phenomenal design. I bet you that thing looks really good because you are maxing it out. The 80 and the 8 is 10-time rule. So 8,000 is 10 times of 80, or 80 is 10 times of 8,000. So that's our super efficient design. And this is kind of what I want to show Christian in a second when I talk about his. All right, so what else? Any questions on that? I love that. Who said circle of money? Frank? That I've never used that, but it is. It's the circle of money. It's the monopoly of money. Every time you pass go, which is your policy anniversary, you get $200, which is your dividend. Oh, so Marietta wants to know about
paying back the loans. So just real fast with the loans, it's completely up to you how you pay back the loans.
Mhm.
whether it's monthly, whether it's regularly, whether it's all at once, or even never. I mean, we always say keep up with the interest, but go ahead, Chris.
So yeah, this is another controversial thing, and this is why we always teach you got to be an honest banker. All right, you got to be an honest banker. If you owned your own bank, would you steal from your bank? Is usually the question I ask from stage, and most people say, "Oh, I would never steal from my bank." But then people get into this, put their money in the policy, take the loan out, buy whatever it is they're going to buy, and then they forget this part. Like, wait a second, that was my money. It was my money. I'm not going to pay the loan back. And then maybe they talked to somebody and somebody was like, you don't have to pay the loan back. And you know what? They're right. The insurance company will never ask you to repay the loan. It's kind of funky, right? When you think about taking a loan from a bank, do you think the bank ever says, hey, you don't have to pay the loan back. Just keep paying the interest. You never have to pay the loan back. You'd never get a bank to say that. But an insurance company can and will, and happily will say that, hey, you never have to pay this loan back. The insurance company's like, seriously, you never have to pay it back until the day you die. Because the day you die, what we're going to do is we're going to come over here to your death benefit. We're going to subtract whatever that loan balance is, plus all that unpaid interest, and we're going to subtract that from your death benefit. We're going to pay you the net. So they get their money. They just had to wait for it. And insurance companies can wait hundreds of years. That's what they're built for. So I always tell people, and the only way I teach it, and you will never find any video out there where I do not teach recycling and recapturing the money back into your policy, which is repaying the loan. That, to me, if you are going to be a banker, if you're going to follow the infinite banking concept, that's not an option. You don't steal from your bank. Your bank will go out of business eventually, or your bank will become insolvent. I'm writing a children's book right now with Hannah Kessler, and you won't know it's about whole life policies and infinite banking because it's about a little girl and her companion. Well, her companion is her policy. She abuses, in this kid's story, this children's book, the companion, by not repaying the companion, by making the companion keep giving her loans so that she can go enjoy and go on trips and protect herself from dragons and protect herself from storms and cold weather. And the companion keeps giving and giving and giving and giving, but the companion is getting weaker and weaker and weaker. What is she doing, folks? She is draining the cash value of the policy, never repaying the loans. The companion will keep giving, and that's the story for the kids. The companion keeps giving, never asks questions, keeps saying, no problem, I've got a little more, take it. Take it. I want you to be happy. A little bit more. Take it. I want you to be happy. But then at the end of the book, the little girl needs help because the dragon's going to basically come in and destroy her village and take everything she has. And she asks the companion, can you help me? And the companion says, no, I have nothing left to give. And then there's a cold winter where she's going to freeze to death. And she asks the companion, is there anything else I can have? And the companion says, I have very little, but I'll give you everything I have, but I might not make it if you take it. At the end of the story, she realizes, like, you can't steal from your own bank. But it's just a kid story with little rhymes, and it's so cute. You'll be able to pre-book that soon. But nonetheless, don't steal from your bank, folks. Did you backdate a whole life that already started? No.
Wow.
Within the first 30 days, maybe. So in the first 30 days of issue, you probably could get the insurance company to backdate, but after that, no way. Once you're out of your contestability period, you're probably done. Oh, that's a good question. So James just, and I get this all the time, so let me hit this. A lot of people will ask me, hey, Chris, I've got a whole life policy, but it wasn't designed like this. Can we replace that one with a new one? Here's the answer, and I'm gonna say this loosely. If you have an old whole life, I don't care what company it was built with, and anyone ever knocks on your door, comes to you, or tells you you should replace your whole life with a new whole life, or God forbid, an IUL, which is what's happening. There are a ton of agents replacing whole life policies with IULs. They should go to jail. And maybe they will. Maybe they'll get sued. There'll be arbitration case after arbitration case. Mark my words, it will happen because that is not suitable. But also what is not suitable, and no one on my team ever will tell you to replace an old whole life with a new whole life. It just does not make sense. Now, the only time that ever could make sense is, let's say you had a whole life policy with a mutually owned insurance company that paid dividends. But then for some reason over time, that mutually owned insurance company demutualized and became a publicly traded company, and they stopped paying you dividends, and they reduced your interest, your dividend. They can't reduce the guaranteed interest. And then they changed everything, and the interest rate on the loans went up. That would be the only time, which is literally like out of 1 million that we would look at, maybe 0.5% of them would hit that, maybe less. So in other words, don't replace a whole life. If you're with a company that says mutual, but they're from the Northwest, so he's referring to a company called Northwest Mutual. a very freaking good insurance company. Matter of fact, one of the best mutually owned insurance companies from a strength standpoint and a rating standpoint. Here's where it doesn't really favor well. If you've got a Northwestern Mutual policy, most of the Northwestern Mutual policies have a loan interest rate of 8%. I'm not saying all, there are different ones, but I love Northwestern Mutual. I think they're a fantastic company. You'll never have trouble. Your cash value will always grow really safe and solid. You'll get a good dividend crediting rate. But when you want to use it for infinite banking and take a loan, well, this is what you're going to do. But does that mean you can't use Northwestern Mutual? No, you sure can. So what we would do is we would say, screw you, insurance company. I'm going to go to a bank. And I know I hate using that word bank, but I'm going to find a bank like Boosie Bank. And I'll give you the name. It is. It used to be M&M, but now it's Boosie Bank. And I will say to Boosie, yeah, M&M and Boosie, two rappers. That's interesting. I wonder if they actually own the bank. But Boosie Bank, what they will do is they will look at your cash value and they will give you up to 100% of your cash value as it's basically a line of credit, but it's a cash value line of credit. They will collaterally assign the policy to themselves so that they're protected, just like the insurance company, when they give you a loan, they collateralize the loan with the cash value. That's what Boosie Bank is doing, and there's other banks. And then they'll give you a line of credit, and right now Boosie Bank, I think, is at 7%. But rates are going down, so I would anticipate in a year this will be less. This is who I use. I use Boosie Bank. It allows me to consolidate all my policies. But would you rather pay 7 or 8? 7. Well, it doesn't. Your policy is still going to grow. I don't remember the dividend crediting rate on Northwestern. It's probably like 5.8, 5.9. You're just, all you're doing is using the bank to get a better interest rate than the insurance company. Let me explain a real story. So back a while ago, when interest rates were, unrealistically low, I was talking to this incredibly wealthy guy, huge real estate developer, had a net worth of in the hundreds of millions of dollars, heard me do a presentation in California, loved it. Absolutely loved everything I said. But then he said to me, he says, the only thing that I have an issue with is when I look at your strategy of using a whole life, he said, I love it. But you see, I've got a brokerage account with one of the major brokerages, which I'm not going to give you. And he had enough money. I can't remember what it was, but usually it's going to be a sizable amount of money. I think let's call it $20 million. He then, what he did is he had a margin account. So because of his account and his relationship, what the insurance or what the brokerage would do is allow him to use up to, I think it was $20 million. He could use all of his money as a loan at current interest rates, which were 3% back then. So he got to take up to $20 million out of his brokerage account, use it without interrupting his $20 million stock portfolio growing. So when we talk about the whole life, I mean, if you had $20 million in a whole life, you could take a loan from the whole life. Right now it's 5.2%, and you can then make money on the $20 million or whatever you took the loan for, plus make money on the $20 million still earning interest. So it's kind of the same. Let's say his portfolio was growing at 8%. Okay, so he's making 8% on $20 million, and he takes a loan against his $20 million. The brokerage uses his $20 million as collateral, so he can't go and take the $20 million out when he's using it, but the margin account charges him 3%. He goes and loans that money on in real estate at 12%. So what's he making? 12 minus 3, he's making a 9% spread. Who the hell wouldn't do that? And over here, he's like, yeah, but and yours, and actually back when I met with him, this is a while ago, loan interest rates were 4, so it was a 2% spread. So he's like, you guys are making a 2% spread, I'm making a 9% spread. What do you think happened, folks? Anyone been paying attention? What did the Fed do when inflation took hold? Raised interest rates. This is the thing that when everybody thinks they're so smart, where they get slapped and kicked in the nuts, okay? Because he forgot that the Fed can raise interest rates, and boy, oh boy, did the Fed raise interest rates. See, we got so comfortable and so used to low interest rates that we forgot that this can happen. Now, all of a sudden, the Fed raised interest rates. What do you think this margin accounts, 3% or whatever it was back then, is tied to? Can anyone say prime? Who controls prime? The overnight rate, which is the Fed. What did the Fed do? Raised interest rates. Did they not? A lot. They raised interest rates to like 5.5, but you see, the margin account wasn't just charging prime. They got to make money, so it was like prime plus 1 or prime plus 2. So I don't know, where was it? It was 5 +2. So now it's at 7%. So you see, and actually some of the margin accounts are double digits now, but you see, this is great when it's good, but not good when it's not good. Over here, did the loan interest rates change on the loans? Yeah, but are they tied to prime? No, they're tied to the LIBOR bond index mostly. So does the bond index go up as fast or is down as fast as the prime? No. So loan interest rates went from 4. It's been bouncing around. So right now I'm using 5.2, but full disclosure, folks, this rate has been changing a little bit lately. Like we went from 4.9 a month ago. Now we're at 5.2. When interest rates go back down, the LIBOR bond yields right now are floating all over the place. So insurance companies are moving interest rates around a little, but very small increases, okay, for the most part. So your yield or your spread is changing, but nowhere near as big as it will with a bank, okay? So that's a great question. Yeah, and some of these brokerages are charging way more. So I'm just using that real example, which I remember 3%, but I bet you some of the, look it up, Google Vanguard brokerage margin percentage. I bet you it's double digits still. Oh yeah, forgot to tell you that. They can call this margin loan anytime. So thank you so much. I forgot to talk about one of the most important things. So this $20 million in the market that he was earning 8%, let's say he loses 30%. Let's say he stays invested, into a recession and loses 30. Let's say he had all that money out working in a real estate deal on the margin. The margin rate went up to 15. He's like, oh, that sucks. But now all of a sudden he lost 30% of his portfolio. So now he doesn't have 20 million. Let's say he's only got 12 million. I don't know what the number is, folks, but let's say he's got 12 mil. What is the brokerage going to do? They're going to be like, Jimmy's good for the money. Don't even worry about it. Yeah, I know we're upside down by about $8 million, but he's going to come through. He's going to be good. Is he good? No. He's going to get what's called a margin call. Actually, you all should know what a margin call is. They made a really freaking good movie all about that. The brokerage is going to be like, pay the piper. But folks, we've got a special surprise for you right here and right now. Florida man has shown up. Here he is. Steven? I'm sorry. You're not Steven. You're Florida man. Tell everybody.
Florida man checking in from South Florida. How's everybody doing? We got 6 days to the elections. We're down here representing Make America Great Again. We're going to take back control of our money. We're going to take back control of our country. We're going to fight, 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 baby. Florida man is here along with my boy. That's all I got.
Listen, just remember who asked for this. All of you asked for this. Shauna was like, no, don't do it. You did it this morning. Yeah, where's your alligator? You should be wrestling an alligator if you're going to be Florida man.
Yeah, that's okay. I'll be back with more. Be right back.
All right, remove the pin. All right, yeah, Seneca, you're right. Brokerages typically don't let you use 100%. So I'm just generalizing here. They're usually 90% max, large accounts only, which is why I use the high net worth client. Usually a margin account will be like Seneca's mentioning, about 50%, because they know there can be fluctuation in the markets and they're anticipating market values going down. So they're not letting you use 90. I think Seneca's absolutely correct. It's probably more like 50%. How much of your policy's cash value can you use? 90%. Does that ever fluctuate? Yes, it only goes up. How many of you want something that goes up, down, sideways versus something that only goes up? My point exactly. So nothing on email. Oh, somebody's asking what email do they send for that buy term invest the difference? Let's see. Let's have it go to Shauna. I always do this to her and she loves it.
I would send it to Craig probably. Craig's got it. All right. So real Florida man's here now. I got my pet alligator.
Hold on. We got to come back.
Here we go, folks. Florida man is here for Halloween, baby. We're ready.
Oh, shit. Hang on. Let me pin you. Now that is about as authentic of a Florida man as you get.
All right. How are we, guys? How are we? We doing good here? We're ready for this Halloween tomorrow. Gun, right? Election next week, baby. Here we go.
That's just a BB gun, right? Or did you kill the alligator with that?
You never know.
All right. Did everybody get photos?
All right.
Halloween in full force.
All right. We do have fun. We do have fun, guys. We do have fun.
All right, Florida man and alligator man and, I don't know, machine gun Kelly. Can you jump back on the screen with the gun? Let's see how good you are at typing with one hand. Drop the gator. Put the gun down. Put the gun down.
All right. What are we doing?
Because I told Christian early on, he was like the first person on. He had a great question, and I wanted to make sure I addressed this. And I want to make sure, okay, Christian, is it okay if I use can I like verbalize, and I won't give your last name, but can I verbalize what you gave me over there in the numbers? Just give me a verbal okay in the chat. Okay, perfect. So Christian said he wants, I should probably even ask that. Christian, male or female? You only have two choices with me. Just want to make sure I get that right. Male?
Yes.
Okay. Yes. All right. Male. Perfect. All right. So here's what we're doing. So Christian is asking, he's saying, all right, I want to see a policy design of $5,200. Now, Christian, we're going to have to really, really ask about this. So $5,200 premium deposit. And now you mentioned minimum. Okay. That's the minimum intro policy. So you were talking about doing that. Now let's come over here. So we've got bills or debts that we want to pay off. I would assume you want to pay these off. So let's just put these on. We got $3,800 in just normal monthly bills. Not too bad. $5,200. Christian, how much is that trailer loan? So $5,200 truck trailer payment business. Okay, so $5,200. I assume that's annual, or is that monthly? I just need some clarification, Christian. So the truck trailer payment, is that a monthly payment, $5,200 a month? And how much is the balance on that loan? Monthly. Okay, so $5,200 a month. So the $3,800 a month, the $5,200 a month, and how much? What's the balance on that? I know he's got a total of $190,000 in debt. Has really strong income. Okay, so we'll just put the income. I'm not going to give you the exact amount, but it's north of $300,000. So $300,000 plus. Okay, so that's the income. Trailer is $80,000. Oh, that's not bad. Truck is $80,000. Okay, so we got a truck loan for $80K. And folks, just so you know, this is part of that $5,200, and then $80 or $6,750 on the trailer. All right, perfect. Which both of those make up the $5,200 a month, correct? All right. So here's the deal. So here's what we got. We got income 300 plus, monthly household expenses 3,800 plus 5,200 in business debt. So 5, 6, 7, 8. So that's 0, 9, about $9,000 a month is what your outlay is. So $9,000 a month. Calculator. So we got $9,000 a month going out, and we're bringing in. I'm just going to generalize this. We're bringing about $29,000 a month in income. Is that right? Times 12. Yeah, about right. Okay. So first question I have for you, Christian, is when we're looking at this, you mentioned you wanted to do a $5,200 minimum policy. Why? If I'm just looking at this and I'm generalizing, if you're bringing in $29,000 a month and you're spending $9,000 a month, let's just round that up to 10. Well, we'll keep it at 9. That means you got $20,000 in discretionary savings that you could do. What am I missing? If that's correct, why would you only want to put $5,200 into savings? Because aren't you keeping $20,000 in a bank account? So is roughly, if by the math, business and personal expenses, you're spending 9 of 29,000, which means you got 20K left every month, which even if we just cut that in half at 50%, that's 10K a month that you have free and clear. And we want to put $5,200 a year into the policy, or is that a month? $5,200 a month? No, can't be. $5,200 a year. Yeah. And you want to put $5,200 a year. Oh, here's Craig. Perfect. That's what I'm trying to figure out, Craig. Let's see. Depends on repairs and how much I run. Yeah, that's why I'm cutting it down, minus 50%, 10, 5. Doesn't matter. I'm just trying to generalize. Oh, $5,200 a month, Craig. Oh, shit. Well, that's a big difference. All right, cool. Now we're back in the game because it's not 50. So you threw me off, Christian, when you said $5,200 minimum. So $5,200 a month is a totally different game. All right, Craig, can you throw together a policy, $5,200 a month? Christian, how old are you? Just need your age and we can kind of have some fun with this. 30, wow. Christian, you're doing well, man. 34 years old, making, over $300,000 a year. You do know if someone wins the election, your taxes are going up, buddy. That was a little below the belt, but we do have Florida man here, so I figured.
Not if I can help it.
All right, so Craig, he's going to put together some numbers, but here's how I would see this. All right, so let's come over here. Got 9,000, actually 5,200 is what we got. All right, so I'm going to put over here. We're just going to do this, Christian. We're going to put your debts over here. Your debts are 190,000. Okay, we got $190,000 in debt, which is costing you $5,200 a month. I think I got my numbers right. So let's just figure this out. Is that, Christian, give me a thumbs up or give me a yes if your $190,000 is your total debt costing you $5,200 a month. I think those are the numbers you gave me, times 12 divided by 190. That seems a bit steep. Yeah, that would be about a 32%, 32.8% interest rate. 9,000, well, 9,000 a month was your total expenses, but how much are those debts? Because all we're trying, this $190,000 in debt, the truck and the trailer, is that costing you $5,200? I'm just trying to, because we don't want to use the policy to pay your expenses. I'm trying to use your policy to just take care of like the debts. But we can assume that that's the case. We can assume, and then I'll wait and see what's coming in. So now let's come over here. So over here, right now, you're looking to save $5,200 a month. So we're going to move that into a specially designed whole life. And we're going to design it, and I'll let Craig kind of play with those numbers. Craig, you're with us, right? Just put I in the chat. Just want to make sure you're tracking with me. And then we're going to do a cash value, and we're going to do a death benefit on that. Okay, so 5,200 times 12, and my phone just froze. That's always fun. Times 12, 62. So each year we're going to save $62,400. So let's just assume 62,400, and you're going to have probably 50,000, maybe a little bit more to use. Is Craig still with us? Yep. He's working on the policy design now. So let's put a pin in that real quick, Christian. We're going to come back to it in just a second. Let's go back. Florida man, do we have any other questions that we can hit? I see a couple. Get interest rates per debt, payments per debt. Okay, so what else we got? Whole life is the way to go. Trump will win, but it will be a landslide. This man also was right in 2016. Kamala pull. Yeah, give me a fun fact while we're waiting for Craig here, because oh yeah. Does everybody know? This is wild. Does everybody know if you have a Robinhood account, and I think there's a few others, you can actually bet on the election? The odds are heavily weighing to Trump right now to the tune of about 70%. Has it swayed, or is it still right around 70? Yeah, I don't know. It's floating around, but I will not be betting. I am not a bettor. I don't bet. When I go to the conferences that we go to at hotels, you know, Steven and the crew, they're always around the blackjack table, and I'm just sitting there, I'm just watching, and all I'm there to do is to say, all right, are you up? All right, you're out. I'm literally the chauffeur to say, okay, you're up, we're done, get out. You know, I keep them from losing money because they're using their own private bank. We don't want to lose. Okay, so the numbers are changing a bit. So a little bit right now, the 6 days until election, you can buy a contract for 63 cents for Donald Trump and 39 cents for Kamala Harris. So yeah, you're 63.39.
What site's that on? Polymarket's got Trump at 66%.
This is Robinhood. So 15 contracts. Yeah, wow, that's just wild.
Polymarket's a bigger one. Almost $3 billion in play, and it's got Trump currently.
Wait, did you just say $3 billion?
Yeah, volume right here, 2.72 billion.
That's a $20 million bet.
Holy shit, man. But wait, hold on. This is where you got to start asking questions. While Craig's putting together these illustrations, like you really got to ask yourself, okay, so if, let's say Trump does win, but they don't let Trump take office, do you still get your payout? I mean, you got to start looking at the real questions. Like, I would want specifics. Okay, what constitutes a win? Is a win when he takes office? Is a win when they count all the polls? Is there any factors or any kind of kickouts for, you know, for voter fraud or, you know, ballot, you know, manipulation or anything like that? There's a lot of questions I have. I'm not taking those bets.
Justin said you're the DD for betting.
Yeah, the DD for betting. All right, well, we're almost done here with Craig, but one more simple, useless fact. We went to Ireland a couple of years ago, and as I went pub after pub, the only beer they really have is Guinness, which makes sense. I'm in Dublin, in Ireland, so the Guinness factory is right there. So every authentic pub I went to, it's Guinness. And just so you all know, Guinness in Ireland tastes completely different than it does here in the US. It is so good. But anyway, every pub I went to, and I went to quite a few, because if you're in Dublin, like, you got to go to pubs. Everyone had another tap outside of Guinness. Can anyone guess what that other beer was that was on tap? There was only one other beer in most of these pubs. Can anyone guess what it was? Anyone? Bud Light? Bud Light? Definitely not Bud Light. They'd probably throw you out of the bar if you asked for a Bud Light.
So like,
No, it was, come on. No, it wasn't Heineken. I'm going to give one more person a shot while we're waiting. Yingling? No. It was Coors Light.
No.
It was Coors Light. So that seems kind of weird, right? You're in these big, you know, crazy Dublin bars, and you're thinking, all right, you know, singer of U2 probably sat right in the seat, and you're looking at the thing and it says Coors Light. And I asked the one bartender, because it was relatively slow. It was probably like 8 in the morning. I'm just kidding. But I'm sitting there and I just asked him, I said, so every pub I've been to in Ireland has Coors Light. Like, why is that the only light beer you guys serve? And he says, oh, well, when a bunch of guys, chaps, I think they call them, or something like that, come and they're all drinking, there's always one designated driver. I'm like, yeah, we do the same thing in the States. Like, we're not dumb. And he says, well, that's what they drink. They drink Coors Light. And I'm like, you're joking with me, right? He says, no, I'm not joking at all. The Coors Light's for the DD. So when you're in Ireland, like, you don't drink water as the DD, you drink Coors Light, damn it. That's a true statement. I swear to God. I swear to God. All right, so total debt's 216. All right, that's better. 216. Hey, Craig, how we doing, man? We're running out of time. We almost, I know we're putting them under a lot of pressure here, but we kind of just, so now let's do the math. 5,200 times 12 divided by 216,028. So now if I know Craig probably isn't just running an illustration. He's probably running a debt blaster as well, because he's asking some funny questions. So we're going to probably be able to tell you, Christian, how long it's going to take to pay that off. Even if he doesn't do it on today's wealth webinar for the sake of time, he's going to be able to show you exactly based on these parameters, $5,200 a month going into a specially designed whole life, $216,000 worth of debt, paying $5,200 a month, works out to an interest rate of roughly 28.88. Now, some of your loans are amortized, so my numbers are off a little bit, but just kind of giving the numbers. So what effectively we're going to do is we are going to take a loan from your policy, okay? And that loan is going to go into a segregated bank account, okay? So we're going to get the numbers in a second. And then we're going to then take the money from the policy and we're going to begin to pay down these debts, which we would need a breakdown of all your debts, but we're just going to generalize it here. And then what we would do is when we pay off a debt, like probably the trailer first, because I think you said the trailer was like, oh, hell, I don't even remember what you said the trailer was. I had it over here. The trailer was $67.50 was owed. So I don't know what the payment is, but we would take the trailer payment and we would then pay the trailer off. So I'm just going to show this right here. We'd pay the trailer off with the first loan, take the amount you were paying on the trailer, let's call it $300 a month, and then take the $300 a month and put it back into the policy, running it through. So this, when it hits the, so up here, we're gonna document the loan with the segregated account. We're gonna document the loan repayment with the segregated account. Our team would help by completing the loan repayment form, and then we would send that money back to the policy. And whatever you were paying on the trailer, in this case, I just used $300 a month, $300 a month would also be going into the policy to be used to repay the next loan and the next loan. And we would just keep doing that quarter after quarter, because you're doing it monthly. So this is just how I do mine. Every quarter we would chip away at debt. Every quarter we would recapture the money that we're no longer paying. We have calculators that figure all this stuff out for you. So we would be able to do each and every single part of this. Craig said he's almost there. He said he's done. All right, can we bring, I'm going to bring Craig on. This is going to be pretty interesting, folks. So I don't know how much time just elapsed there, but it wasn't all that much. I mean, it was enough time for Florida man to go out and kill another crocodile that was trying to eat, I don't know, his dog or his cat or whatever. Do you have any animals, Stephen?
Yeah, I have a 90-pound dog.
Well, that's no match for a gator. Faster, though. I would assume a dog is faster.
Oh,
All
you would
right,
be surprised, man. You'd be surprised. Gators are really fast. It's one of the reasons people get eaten. They don't realize how fast gators are.
Really?
On land, in water, you'll never outswim them. Water, they're way faster. But on land, you're not outrunning a gator on land.
I heard to outrun a gator, you got to run like this because they got tiny little feet. So you got to run in like, circles like that. But I think that could fail because if the gator ran straight and you did that, you're going to intersect. It's going to be kind of like how Josh Allen throws the football.
That's a New York thing. That's not real.
Really?
Yeah.
Well, that's what you do with a bear, and it doesn't work either. We have bears up here.
Exactly.
All right, Craig, you got share capability, so whenever you are ready. Google said gators can run 20 miles. How the hell could a gator run 20 miles an hour?
They wear really nice sneakers.
Oh, they have nice sneakers. They probably
They've
have
been
those
around
nice.
for millions of years, man. Millions of years. They've learned how to evolve.
Hey,
Can a
Chris,
gator
you
climb a
okay?
tree, though?
Well, you asked me to pull a rabbit out of the hat, so I think I'm there.
And I'm going to go a little over today because I got to show people the difference between direct versus non-direct, which is where I started. I almost forgot about that. I just looked down. I'm like, shoot, forgot that.
Yeah. So one quick thing. So the debt balance is 216,000. Is that correct?
That is correct.
And he's putting in 5,200 a month in debt payments.
$5,200 a month into the policy. Yeah, $5,200 into the policy. Yeah, they're the same. 5,200 and 5,200, so it's the same.
Okay. All right. And the interest rate was 28 something?
I calculated it 28. It's probably not because it's probably an amortized loan, but that's what I came up with.
All right. So you want the results.
Well, I don't, but I think Christian does.
All right.
Christian, you still with us? See, even Christian said you zigzag, and he's not from New York. Google humans about 5 miles an hour. Gators are 20. Yes, Florida man for the win.
Christian did say total debt was 216. So you know.
Yeah.
All
Even
right.
if we're not 100% here, but we're still going to be able to show him the debt blaster here.
Yeah, so I threw a policy together with his 5,200 a month on a 75-25 split. So I mean, 75% of that's going to paid up additions, 25% to the base. So if he were to pay that debt off in option one, so no, option one is you just continue to pay that 5,200 a month at 28%. He'll be paying $682,000 in interest. That's pretty wild, huh?
That is very wild.
So what we're going to do, Christian, is we're talking about putting the money in the policy, taking the maximum loans. You could take them out every quarter or every month. Most times it works better just do it every quarter. That third party debt would be gone in 34 months. Okay, so you would essentially move that debt into the policy. And then for the next 32 months, you'll continue to run that 5,200 back into the policy. So we're not doing anything differently. That 5,200 used to go out to your debts. Now we're going to run that into the policy. So basically in 66 months, your debt's gone, your policy's paid back in full. And we're comparing that to about 173 months if you continue to do what you've always done. So we carved off quite a bit of time there. Now, what we look at is how much interest are you paying using infinite banking versus not using infinite banking. Your interest, just doing it the way you've always done it, is 682,000. Interest now is about 112,000. So pretty big difference there. At the end of 66 months, based on the policy design we put in place here, you'll have about 333,000 in cash value and a death benefit of 1.7 million.
And when we do this, most people are just like, ain't no way that's possible. That's too good to be true. No, folks, that is just math. That is all that is. Literally just mathematics. No fluff, nothing else. That is just the computer doing the math for you way quicker than our app, our calculator does here. I mean, 34 months. Craig, the biggest thing I can't believe here is even if we changed all the debt payments down, you're still paying it off in 173. Actually, I think those are the same. So 30,
Yes.
60. And the other thing too, a lot of people are like, well, 34 months, all the debts are gone, but then it's another 32 months to pay back the policy. But remember, when you're spending this 32 months of paying back the policy, you're building liquidity for yourself. $5,200 every month is going into your policy and you get to use that money. So when people think of a debt payment, that's $5,200 gone, never coming back. Here, in that second swing, the 32 months, that $5,200 that you're using to repay your policy, all that money's available again. So $5,200. So by the time you're done with that, I mean, that's pretty substantial.
Yeah, and Chris, just so you know, on the option two, I put all the debts in one debt. So if he's got a truck loan, credit cards, personal loans, that's where this option would be a little differently because we're going to be sequentially blasting those away. But I just put the 216 as one big chunk of debt. So when we do his actual debt blaster, we'll break out each debt to figure out which one to focus on first.
And one other question that came in from Chris Snow is he was asking, is that death benefit after the 66 months? Is that where you get the death benefit?
It is after the 66 months. So these numbers, the 333,000, the 1.7 would be after we're done paying. So at month 66, these are the numbers.
So Frenchie just came on and said, if you have $500,000 in a self-directed IRA, can you move half of it into an IUL? Frenchie, can I ask you a question? Did you just hop onto the webinar like a little bit late, maybe like just now? You haven't been here the whole time, have you? Because I don't think that would be the question you'd ask if you've been here the whole time. I spent the first 45 minutes, maybe 40 minutes, discussing IULs and how they don't work for anything that we teach. And also, if you had $500,000 in a self-directed IRA, you would never, ever, 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 ever want to move that money from a self-directed IRA into an IUL or even a whole life. Okay, so keeping the level, like why pay the taxes on the self-directed IRA to move it into the IUL or whole life. It wouldn't make any sense. So we would never recommend that. But anyway, Yvette, we don't give the calculator out to the public yet. We build these reports like that one for our clients when they go through us to get their policies. So it's kind of an added service on our implementation team and our concierge team for every one of our clients. So if we design your policy for you, you get that entire service, no cost. We do not have that available for the public. We may in the future, but as of right now, that is not available to the public. So I think the real question is, Christian said, would love to set up a policy. So does anyone think Christian should have any reason not to do what Craig just built for him? So Craig, could you hit up Christian in the Q&A and give him your contact info to set up a call?
Yeah, absolutely. Let me
Christian, I hope that was worth your time and hanging with us there for a little bit. Hey, Craig, while you're doing it, I just want to say thank you so much for doing that on a whim. I was not thinking it was going to happen, but it actually did. So pretty cool. Christian, get with Craig. He's already got it built. You guys can flush the numbers out and make that happen. That is the fastest we've ever solved the problem, just so you all know. So that's pretty fun right there. All right. So real quick, I got one final thing. I know we're over. If you guys got to jump, I totally understand. It's my mom's birthday today, so I am jumping out of here right after that. But we're going to come back to the original reason I was telling you one thing I was going to show you was the direct versus non-direct. So let me get back to that slide, and I'm going to just show you very simply the difference between a direct and non-direct policy in a 5-year time frame. And the longer you go with direct versus non-direct, man, I used a lot of board. The longer you go, the more the difference is going to be. I didn't think I drew that much today. You guys had me working. That's why I'm sweating. So here, we're going to do this super quick. So this is a client of mine. This client has had this specially designed whole life. It is a direct recognition company. So I'm just going to say I'm going to go 5 years in. Okay. So I'm just going to write it down here. 5 years into this policy, none of the numbers matter. I'm just going to give you the cash value. So when we first set this up, based on the assumption of dividends he was supposed to get with this company, he should have had $84,047 in cash value. So this is how much money he was supposed to have, $84,047 after 5 years. Okay, so if he just left the money in the policy, that's how much he would have. Oh, look at you go, Craig. Craig's, what, is that the Colorado man? Oh, hold on.
Colorado man's here, man. What's up, man?
We got Florida man and we got Colorado man. Nice.
Look at that. Where's New York man?
Mile high Craig. Craig is good in the sheets, folks. Craig is good in the sheets. Okay. So now this client didn't leave the money in the policy. He took loans every single year. So because he took loans, because it was a direct recognition, he's getting dividends on a lower cash value. In the 5th year, his cash value is $80,592. So the direct recognition in his policy versus the non-direct would have cost him roughly about $4,047 over that 5-year time frame. Now, he wasn't super concerned about it because he took this $84,000 in loans out and he made that money go out to work in private loans and real estate deals. So he made a bunch of money. So he didn't really care, but this is the difference. So when you go direct recognition versus non-direct recognition, you're seeing it, the math. So the cost for the recognizing of the loan roughly was about, and there's other factors, but roughly about $4,000. So I hope that was worth waiting for, but I think it was, because I mean, that shows you, and I've never been able to do that because I've never had an illustration that I could show that with, but now I do, and we'll do more stuff on that later. A couple of final closing things. If any of you want the buy term invested difference white paper, debunking buy term invested difference is the ultimate king in this. We show you how using a specially designed whole life and investing it from the whole life far outweighs buy term invested difference. If you want that, you can email Craig@chrisnaugle.com. He created that. With that, Stephen, what else do we have to announce? We got some stuff with Money Tank. You want to get that out from Florida, man?
Yeah, man. So I'm going to be in Charlotte, North Carolina, making my way up north next week to the Private Money Club Money Tank event. So November 7th, flying into Charlotte, North Carolina. We are staying at the Hilton, doing a little welcome reception Thursday evening for everyone. And then starting first thing Friday morning at 8:30 a.m. over at the Charlotte Motor Speedway. Money Tank 2024 is kicking off. And we're going to go all day Friday, have a little VIP dinner and get together Friday night. Saturday morning, Saturday along back at the Motor Speedway. And then Saturday night, we are all going over to the dirt track NASCAR races, which if you've never experienced dirt track racing before, it's a whole lot of fun. And we're going to do a whole lot of business over those few days, make a bunch of new relationships, and help everyone succeed. So we're really looking forward to it. Now, if you can't make it in person, we did just release virtual tickets. So let me get you a deal actually for the Wealth Webinar people, Chris. So anybody that can't make it live to Money Tank, make sure you buy a virtual ticket because you can hop on, you can watch while we're going along. All of the speakers during the breaks will be coming over, talking to the virtual crowd, and we're also recording the whole thing. So after the event, we'll give you the recording so you can go back and catch anything you missed and watch it again and stuff like that. So make sure you buy a ticket, at least for the virtual, if you are not going to be able to make it live and in person. And I'll put that link over in the chat box, but it's privatemoneyclub.com/money tank, and then use discount code what is it? PMC virtual?
PMC virtual.
Yeah. PMC virtual, all one word, for basically 50% off, $100 off of the $197 price. All right.
Okay.
Cool.
All right.
We're hooking that up.
Bring us home and close us down, Mr. Florida man. You look way better than I do.
No, this was great today, man. Good stuff about the IULs and kind of what that looks like. There's some really good case studies there. So if anybody's looking to get started with this stuff, you have some debt to pay down, you just want to kind of talk through your situation, what's going on with your retirement accounts, our money mentors are ready to go for you. So just schedule a call with our team. I'll put it over in the chat box right now. It's mentors.beyourownbanker.com. Go there right now, schedule a call with our money mentors. We'll kind of talk to you about your situation, what you got going on, and how we can help you moving forward in the future. So appreciate everybody being here. If there's any other questions, join us at 4:30 Eastern today, either on the YouTube channel at the Chris Naugle or over on Facebook, any of our Facebook channels. We're going to be doing a live Ask Me Anything like we do every Wednesday at 4:30 p.m. Eastern, answering all your questions.
Final thing, folks, the brand new 2.5 version of PMC is launching early November. This is a snapshot of it. It is so much better than the old one, so much faster. Everything, I'm not logged in, but everything on this site is just epic. I think all of you are going to love it. So if there's any of you that are using PMC right now, this is the brand new site that you're going to be using very soon. So it's a lot of fun. It's easy to use. It's fast as hell. It's got a lot of new features, and it's much better to get deals done because every single deal has a timer now. So with that being said, folks, thanks for joining us for another episode of Wealth Webinar. Thank you, Florida man and Colorado man, for joining us today. And thank you, Colorado man, for being good in the sheets. Christian appreciates it. With that being said, we'll catch you all on the next Wealth Webinar. Till then, see ya. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.